Hello, and welcome back to Insight to Invest, the channel that gives you insight into a company and you decide whether or not to invest. Picture this. It's 3 a.m. A hacker in a dark room halfway across the world just found a back door into a Fortune 500 company. In the old days, that they would be in there for months stealing data while the company's antivirus just slept. But today there's a digital bouncer at the door that doesn't sleep, doesn't blink, and gets smarter every time someone tries to pick the lock. That company is CrowdStrike. CrowdStrike, ticker symbol CRWD. CrowdStrike is the front line of a global digital war. Today we're breaking down CrowdStrike. We'll look at the napkin story of how they started, their insane 2025 and 26 financials, and we'll run a valuation model to see if the stock is actually a bargain or way too expensive. Let's dive in. To understand CrowdStrike, you have to understand the antivirus lie. For decades, companies like McAfee and Norton sold us signatures. Basically, if a virus was known, they'd block it. If it was new, you're toast. In 2011, George Kurtz, who was actually the CTO of McAfee at the time, was on a flight. He watched the guy next to him for 15 minutes try to get into his laptop as his antivirus tried to load. He realized the tech was bloated, slow, and failing. Legend has it, George and his co-founders sketched out the pillars of a cloud-native security platform on a napkin in a hotel lounge. No bulky hardware, no slow updates, just a tiny agent on your computer that talks to a massive brain in the cloud. They launched in 2012, and by 2014, they were the ones who investigated the Sony Pictures hack. So how does it work? It's called the Falcon platform. Imagine if every time a thief tried a new trick to pick a lock in London, every door in New York, Tokyo, and Paris instantly learned how to block it. That's CrowdStrike's threat graph. They protect the edges, your laptop, your phone, the server in the basement. They use agentic AI. It doesn't just wait for you to click a bad link. It predicts malicious behavior before it happens. They moved way beyond just antivirus. They do identity protection, cloud security, and even Falcon Flex, which lets companies swap security models like Lego bricks. But of course, we can't talk about CrowdStrike without talking about the outage. On July 19th, 2024, CrowdStrike pushed a routine rapid response content update to its Windows users. It wasn't a hack, it wasn't a cyber attack, it was a tiny logic error in a configuration file known as channel file 291. Because CrowdStrike software lives at the kernel level, the very heart of your computer, that tiny error caused Windows to panic. The result? 8.5 million customers hit the blue screen of death simultaneously. Airlines like Delta were grounded for days. Hospitals had to cancel surgeries. Even 911 dispatch centers went dark. Because the computers were stuck in a boot loop, IT teams had to manually fix them one by one. It was a nightmare. The stock plummeted nearly 45% in the weeks following the crash. Critics argue that CrowdStrike had too much power and not enough stage rollout testing. But here's the interesting part for investors. They didn't see a mass exodus. By 2026, we can see that their gross retention stayed above 97%. Most companies realized that while the update was a disaster, the alternative was being unprotected against actual nation-state hackers. They apologized, changed their testing protocols, and essentially bought their way back into favor with customer commitment packages. It was a near-death experience that weirdly made their moat look even deeper once the dust settled. I personally bought CrowdStrike stock shortly after this happened. At one point, I was up greater than 100%, but their stock price has pulled back some from its peak. Now let's talk numbers, because in 2026, CrowdStrike is a certified cash machine. In their latest Q3 report, they hit a $1.23 billion in revenue for a single quarter. That's up 22% year over year, but the number Wall Street really cares about is ARR, annual recurring revenue. ARR tells you what's going to happen next year. If a company has $1 billion in revenue, but its ARR is $1.5 billion, it means they signed a massive amount of new deals late in the year that haven't fully shown up on the income statement yet. This is a huge buy signal for growth investors. As of late 2025, their ARR is sitting at nearly $5 billion. That is guaranteed money coming in every year like a giant utility bill. So, software as a service rule of 40. What is that? For software companies, ARR is used to see if a company is healthy. Using the rule of 40, it combines growth and profitability. ARR growth rate percent plus free cash flow margin percent should equal or be greater than 40. So for CrowdStrike, their ARR growth is usually around 30 to 33%. Their free cash flow margin is usually around 30%. So 33 plus 30 equals 63. Since 63 is much higher than 40, Wall Street considers them an elite high performer. Their gross margins is a massive 81% on their subscriptions. For every dollar they take in, 81 cents stays in-house after subtracting direct costs from their subscriptions. Now let's talk about free cash flow versus net income. As we can see here on the screen, their net income is in the last quarter was negative $34 million. But their free cash flow that they generated last quarter was nearly $300 million in free cash flow last quarter. So the reason there's a large difference between net income and free cash flow with CrowdStrike is because CrowdStrike does stock-based compensation. CrowdStrike pays its employees partially in company stock in net income. This is counted as a massive expense, over $800 million. But because the company didn't actually write a cash check for that stock, it gets added back to the free cash flow. They also have deferred revenue. Customers often pay a 3-year subscription upfront. CrowdStrike gets all that cash on day one, increasing free cash flow, but accounting rules say they can only count it as revenue slowly over the course of 3 years, which lowers their net income. All right, time for the fair price talk. Is CrowdStrike a buy at $440 to the $450 range? Software as a service, or SaaS, is tricky to value, but we use a forward price to sales and a discounted cash flow model. Forward PS ratio equals market cap divided by the estimated sales for next year. So why are we using the PS ratio instead of the PE ratio? You'll notice that many people don't use the popular PE ratio for companies like CrowdStrike, because CrowdStrike often has a zero or negative net income, as we just saw. If a company isn't profitable yet, net income is negative, a PE ratio is mathematically useless. However, every company has sales or revenue. The PS ratio allows you to value growth companies that are intentionally losing money now so they can capture the market later. So the PS ratio tells you how many years of sales you are paying upfront to own the stock. So a low PS ratio, usually between 1x to 2x, usually found in boring or low margin businesses like grocery stores, Walmart, or car manufacturers like Ford. They have huge sales but low profit per sale. A high PS ratio, like 10x to 20x, found in high growth tech stocks like CrowdStrike or Nvidia. Investors are willing to pay $15 today for every $1 of sales because they expect those sales to double or triple very quickly. But the danger of that is a high forward PS ratio is a perfection price. If a company is trading at 20x forward sales and they report a slightly bad quarter, the stock usually crashes. Why? Because the hype, which is the price, was way ahead of the reality, which is the sales. So forward PS ratio is a valuation tool that asks, based on what we think this company will sell next year, is the stock price too expensive today? Currently, the market is paying a premium. CrowdStrike trades at a PS ratio of around 24x. If you compare that to the industry average, which is about 10x to 12x. Why so high? Because the market expects them to keep growing at 20% plus for the next 5 years. The fair value calculation. So for the fair value calculation, if we look at analyst consensus for the next 12 months, the average price target is roughly $550. So for the bull case, they continue to dominate AI security, and the bulls have a price target of about $590 plus. For the bears, see competition from Microsoft or Palo Alto Networks, and they have a price target of $350. For myself, I would like to get additional CrowdStrike stock at about $385 a share. If you're a long-term believer in the security cloud, you're buying the growth, not the current PS ratio. So CrowdStrike is the blue chip of cybersecurity. They have the founder-led energy, the best-in-class tech, and financials that make most tech companies jealous. Yes, the stock is expensive by traditional metrics, but in tech, you usually have to pay up for the best. The real question is, do you think cyber attacks are going to get less frequent in the future? Probably not. But you must also ask, will other companies take market share from them? If you want a company that's essentially a tax on the internet's existence, this is it. But I want to hear from you. Are you holding CrowdStrike for the long haul, or is the valuation too spicy for your portfolio? Drop a comment below. Don't forget to hit the like button if the breakdown helped you out. I'll see you in the next one. Bye.